Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder back again with another ETF Spotlight. And today we're going into the world of collateralized debt, specifically the CLOI ETF by VanEck. And we are joined by Bill Sokol, who is the Director of Product Management over there. So thank you so much for taking the time to join us today, Bill. I want to dive right into this fund because it's not really an area a lot of investors like to pay attention to. It's more niche, right? So maybe for the people that aren't really aware of the space, can you start us off by giving us the birth of the fund as well as what is a CLO?
Sure. And thanks for having me. It's interesting that you call this niche because it's actually a very large market. It's about $1.2 trillion in size. And it's been around since the 90s. So
I'll clarify real quick because that is a good point. For the retail investor space, it may come off niche, but for everybody else, you definitely are in it.
Yes. It just hasn't been accessible to non-institutions. And that is why, a lot of people are just now learning about the asset class. And you really can't talk about CLOs without talking about the leverage loan market. Leverage loans are, these are loans arranged by banks and syndicated out to multiple investors. This is a $1.7 trillion market in the US. It's very large. It's very liquid. And leverage loans are made to cash flow generating companies. They're senior to other forms of debt, like high yield bonds, and they're also secured by assets. And all this has led historically to lower loss rates in loans versus bonds. And the reason I mention loans is because CLOs are portfolios of leverage loans. They're securitized pools of loans. And what I mean by that is that the CLO will issue debt in order to purchase the loan portfolio. And typically a CLO will hold 200 to 300 individual loans. The debt that gets issued has different levels of seniority and different ratings. So AAA down to BB typically. And the more senior tranches are, of course, the safest. They get paid first, and they're the most insulated from losses in the portfolio. And of course, as you move down in quality, you're closer to those potential defaults, but you're also getting a much higher yield. So what this does is it allows investors to tailor the risk return profile that they want to get to a CLO from AAA down to BB. And that's important because leverage loans are a non-investment grade asset class. So you can get investment grade exposure to this asset class that's generating very high yields, but with a lot of risk protections built in. And I should mention, in addition to just the structure, they're also actively managed. There's a lot of covenants and investment guidelines that the manager has to adhere to. And there's also excess spread and over collateralization in the structure as well. So they're very robust structures. And to your question, why did we feel it was the right time to launch? Well, we launched in 2022. And the fact is that this really wouldn't have been possible until a few years ago because of the regulatory framework of ETFs. It didn't allow for things like CLO ETFs until about 2019. And then in 2022, remember, we were also in a period of much lower interest rates, but the Fed had just started hiking rates. So that made floating rate assets very attractive. We just wanted to provide a better way, I guess, for investors to access the asset class as well. We wanted to provide a strategy that wasn't constrained to a single rating, so that investors can find the best opportunities within the CLO capital structure. So CLOI is a broad investment grade strategy. And we think that can provide better outcomes for most investors within a core bond portfolio.
Yeah, and I'm glad you kind of clarified there. I mean, since mid 2022, when you launched the fund, over $1 billion in assets under management now, the dividend yield kicking out about 6.25%. So definitely that yield play as you're talking about. So I think in an effort to kind of present the knowledge to the retail investor, as you mentioned, this is more traditionally an institutional play, and we're trying to catch everybody up to speed about the grading of the tranches and maybe trying to get the framework of those who are a little bit older, who saw the cycle of GSE and might hear the word tranches and have a little bit of a moment of shaking and wobbliness. What's the difference between the way these are graded and rated and invested in now versus a period of something like back in 2007, 2008 that people's memory might immediately flash back to?
Yeah, and that's probably one of the most common questions we get. What's the difference between a CLO and a CDO, right? They sound very similar, and obviously CDOs are associated with the GFC. The biggest difference is really a result of it's driven by the underlying, right? If you securitize a portfolio of, for example, subprime mortgages where there's all sorts of underwriting issues, the rating agencies had the wrong assumptions, right? This saying garbage in, garbage out, and that proved to be true. And a lot of these just blew up and there were massive loss rates. CLOs were around in the GFC and they performed remarkably well. There were very few defaults. And that goes back to the strength of the underlying, these leverage loans, right? Again, these are actual companies, and an analyst, a CLO analyst can look at what's in a CLO and do their due diligence, understand the companies, analyze their management, right? You could not do that with these other securitized credit products like CDOs back in the crisis. But you can actually look into a CLO, do that due diligence and decide whether it's a good investment.
So when the team over there is looking for those quality aspects that you keep referring to in the CLO and then what's all packaged together, how do you define quality in the space? Like for the investors, maybe pull back the curtain a little bit and say, this is what we're specifically looking at. Can you share any insights there?
We actually decided to partner with PineBridge Investments. They're the sub-advisor to the fund because they have decades of experience in the CLO market. And actually CLOI is based on a strategy that they've managed for their institutional clients for many years. The fact is you can't rely on a rating alone. You can't rely on the credit rating, and even deals with the same rating can actually perform very differently. So it really starts with a bottom-up analysis. So PineBridge will analyze CLO managers. They'll assess their style, their strengths. Do they have the resources that you need? And of course, track record. But on top of that, PineBridge does its own, what they call re-underwriting of every CLO portfolio. So you may have a manager you like, but maybe the portfolio itself of an individual CLO, they don't like for some reason, right? And that can just be a factor of when the deal was issued. So PineBridge has a very large team of credit analysts, and they can actually overlay the fundamental views of the credit analysts with every loan in a CLO portfolio. There's also deal level analysis. So looking at the deal documentation, because CLOs are not standardized. Every deal can be different, and you really need to understand some of the nuances that are in the CLO legal documentation, essentially, which spells out all the different rights of every debt holder. And then they can do stress testing, right? With the deal, they know the portfolio, and they can apply different defaults and recovery scenarios to that. There's also a top-down element that's really more driven by macro views and the outlook. So maybe PineBridge will think it's a good time to add risk, get higher yields if you're maybe in a favorable credit environment where and spreads represent attractive value. But there could also be periods where they think it's better to take risk off the table, potentially avoid drawdowns if we do see weakness. And this is all possible because the strategy is not constrained to a single rating, and you can then capture the opportunities wherever they emerge. But it is really a bottom-up and top-down analysis, and both of those can add value.
So when investors are looking at specifically this fund and thinking about, as you said, like the overall market look, the market environment and what's going on across the market, are there certain conditions that support the specific type of strategy versus, for example, Liberation Day, anxiety, volatility within overall equity markets and treasury markets, right? Moving rates, maybe the Federal Reserve coming in and changing the actual Federal Reserve fund rate. How should investors be looking at the supportive conditions versus something that might hurt a strategy like this?
Well, I think, supportive conditions are things like high base rates. And we've certainly seen that for the last few years. After the Fed stopped hiking, the Fed funds has remained very high. And that's led to high coupon income, which has really driven returns. But, it also, the floating rate nature of CLOs also allows you to sidestep rate volatility. And that's been another thing we've seen a lot of in the last few years, right? Volatility and longer term yields. So I think you're going to see outperformance in a period, right, where you do have this rate volatility and high base rates. And we expect that to continue. And then credit spreads. So higher credit spreads are something that we've seen in CLOs for the history of CLOs. Higher credit spreads versus bonds and loans with the same rating. So you're getting a pickup in spread versus the same rating. You don't have to take on more risk basically to get a higher income. The headwinds that, where maybe you see less supportive conditions. Now the Fed cutting rates will mean yields come down. We don't anticipate that. And the fact that when you have a full capital structure to invest in, you can still get attractive yields if you move down in quality. So that's something to remember, right? The coupon will go down if the Fed cuts, but having the ability to add risk can mean you continue to get high absolute yields.
So before we get out of here, I'm gonna ask you one more question because I think the level of risk, right, as you were talking about, if the Fed reduces rates, then you can go down into those lower tranches that aren't considered as easily safe, right? You're going to add risk, as you're saying. But is there anything within the fund of a cap to how much risk you are allowed to take, or can you move all the way down the ladder?
Well, it's an investment grade strategy. So we're always going to be at least 80% investment grade. That's the prospectus guideline. Typically, it's going to be more than that. There's an ability to have a small allocation to double Bs, nothing below double B. And the reason for that, that to allowing that is really to be opportunistic. So when you do have a sell-off, which we haven't really seen to any great degree since launching, but when you have that, you can see spreads widen significantly, not just in double Bs, by the way, even single As and triple Bs. And when that happens, we want to be able to take advantage of that, including, opportunistically in double Bs. But overall, it's an investment grade portfolio. We also, another thing to keep in mind is liquidity. It's an ETF. There's daily liquidity. So liquidity risk and liquidity management were really front and center when we structured this portfolio and the strategy with PineBridge. So you're always going to have a minimum allocation to higher quality CLOs in this fund. And the reason is that those are the most liquid, where you have the tightest bid offers. So we want to make sure there's always adequate liquidity in the portfolio.
Yeah, I just want to encourage everybody that's watching right now. If you haven't looked in this space, go check out CLOI. I mean, you can look at the chart of the price by yourself, but really this is that yield focused income that you might be looking for. This might be a good opportunity for you. So check it out here on Seeking Alpha. Bill, thank you so much for your time today. Really appreciate the discussion. Thank you for walking us through this fund. Because I know it's a little foreign to the retail investor, which I know we have a lot within our audience. So we can't thank you enough.
Thanks for having me.
Yeah.
All right, everyone. This has been another episode of ETF Spotlight. We'll see you here again next week. Take care.